The economic gap between the US and the Eurozone has almost tripled since the foundation of the euro. According to the IMF in 1999, the year the euro was introduced, the US economy was the same as the Eurozone in purchasing power parity terms. Since then, the Eurozone economy became 4% smaller than the US economy. The IMF forecasts the Eurozone economy to be 6% smaller than the US economy in 2028. Even in per capita terms, the US is leaving Europe far behind. As of 2022, the average American enjoyed real income that was 35% higher than that of the average European in purchasing power parity terms, up from 27% just before the 2008 financial crisis. At first glance, one might believe that the economies of the United States and Europe are on equal footing, given their advanced technological capabilities and substantial industrial bases. However, the reality is strikingly different. The US economy is not just keeping pace, it's racing ahead, leaving Europe grappling with its economic models and struggling to keep up. The stark divergence in economic performance between the US and Europe can be traced back to several key factors that underscore the resilience and dynamism of the American economic model. For instance, while the US gross domestic product, GDP, grew at a robust rate of 2.5% in 2023, reaching $27.36 trillion, major European economies like Germany and France struggled with sluggish or contracting growth rates. Germany is forecasted for a modest 0.3% growth in 2024, while France is expected to grow by around 0.6%. One significant advantage the US holds is its ability to innovate and adapt rapidly. The American economy is buoyed by a strong entrepreneurial culture that is supported by a legal and policy framework conducive to innovation. For example, the US is home to Silicon Valley, a technology hub that not only leads in high-tech innovation, but also contributes significantly to GDP through tech giants such as Apple, Google, and Facebook. In contrast, Europe often faces structural rigidities in its labor markets and a regulatory environment that can stifle innovation. European labor laws, though protective of workers, can discourage hiring by making it difficult and costly for companies to lay off workers during downturns. This rigidity can lead to higher long-term unemployment compared to the US. Moreover, the investment landscape in the US is much more vibrant. In 2019, the US saw venture capital investments that dwarfed those in Europe, with American startups receiving $136.5 billion compared to Europe's $34.3 billion. This stark difference underscores the greater confidence and resources available to US entrepreneurs, enabling them to scale operations and innovate more rapidly than their European counterparts. Additionally, the US benefits from its unique monetary policy flexibility. The Federal Reserve has been able to respond more dynamically to economic fluctuations compared to the European Central Bank, ECB. While the Fed implemented significant rate cuts and fiscal stimulus in response to the COVID-19 pandemic, the ECB faced limitations due to the diverse economic conditions and political climates across its member states. Furthermore, the US's approach to international trade and investment has been more aggressive and arguably more effective. The pursuit of policies aimed at protecting domestic industries, while controversial, has often insulated the US economy from global economic downturns better than Europe's more open market approach. The dynamism of the US economy is further illustrated by its flexible and responsive financial system, which has been crucial in supporting business growth and innovation. American banks and financial institutions have a long history of adapting quickly to changing economic conditions, providing loans and credit with relatively less bureaucracy than their European counterparts. This agility has been instrumental in facilitating quick rebounds from economic recessions, including the recent COVID-19 crisis, where the speed of financial aid to businesses and individuals under programs like the Paycheck Protection Program was critical in stabilizing the economy. Europe, on the other hand, has often struggled with a more fragmented banking system, especially in the aftermath of the Eurozone crisis. Banks in countries like Italy and Spain have faced challenges with high levels of non-performing loans, which have hindered their ability to lend freely. This has stifled entrepreneurial activities and delayed economic recovery in several European nations. Another area where the US excels is in its labor market's adaptability. The American labor market is characterized by high levels of mobility and flexibility, which allows for a more efficient allocation of labor resources. Workers in the US tend to change jobs more frequently, encouraged by a culture that values diverse experiences and skills development. This mobility helps in reducing mismatches in the labor market and allows for rapid adjustments to economic shifts. Contrastingly, many European countries have more rigid job protection laws, which, while aiming to provide job security, often result in lower mobility and higher youth unemployment rates. Such regulations can discourage companies from hiring new staff, particularly during economic downturns, leading to slower overall economic growth. Education and skill development are also key differentiators in the economic trajectories of the US and Europe. The US education system, particularly at the tertiary level, is highly decentralized and competitive, which drives quality and innovation in educational offerings. Universities like MIT, Stanford, and Harvard are not only revered for their academic rigor, but also for their cutting-edge research and strong ties with the industry, fostering an environment of innovation and entrepreneurship. In Europe, while there are many prestigious institutions, the connection between higher education and the labor market is often less pronounced. This sometimes results in a skills gap where employers find it challenging to fill high-tech roles. The European Commission has repeatedly emphasized the need for education systems across Europe to focus more on digital and entrepreneurial skills to boost the continent's competitiveness. Investment in research and development, R&D, is another critical component. The US consistently outspends Europe in terms of percentage of GDP allocated to R&D, with private sector investment playing a significant role. In this graph shown here, the EU's average R&D intensity remains below levels in China at 2.41%, Japan 3.34%, and the US 3.46%. This investment drives technological advances and supports high levels of productivity and economic growth. On the energy front, the US has made significant strides in becoming more energy independent, largely through advancements in extracting shale gas and oil. This energy independence has not only reduced the cost of energy for businesses and consumers, but also provided the US with greater geopolitical leverage. Europe, by comparison, remains more dependent on energy imports, which can be a vulnerability, as seen with the reliance on natural gas imports from Russia. The EU imported over 38.7% of its total gas consumption from Russia in 2021, leaving it exposed to supply disruptions and price volatility. Looking to the future, it is clear that for Europe to bridge the economic gap with the US, significant reforms are needed. First and foremost, Europe must foster a more business-friendly environment by easing regulatory burdens and enhancing labor market flexibility. Encouraging a culture of innovation and entrepreneurship, similar to that in the US, could invigorate the European economies. Additionally, European countries need to invest more in digital infrastructure and education to build a workforce that is capable of meeting the demands of the modern economy. Boosting R&D investment, particularly in green and digital technologies, could also play a crucial role in enhancing productivity and sustainability. Furthermore, enhancing the European banking system's ability to support economic growth through more integrated financial policies and better capital allocations would help in stabilizing the economy and promoting investments. In conclusion, while the US economy currently has several advantages over Europe in terms of growth and innovation, Europe has the potential to redefine its economic landscape. By adopting more flexible economic policies, investing in future-oriented sectors, and fostering a culture of innovation, Europe can pave the way for a more prosperous economic future.